As we enter 2026, a paradox is becoming increasingly difficult to conceal in the U.S. economy. While statistics may still tell a stable story, the wallets of millions of households tell a different one. Credit card debt has reportedly surpassed trillions of dollars, while interest rates across many segments consistently hover above 20% per year. Just one late payment can turn a temporary expense into a burden lasting for months. Remarkably, this is no longer a story of a small group with poor financial management. Signs of mass survival are appearing in everyday behaviors: delaying doctor visits, cutting back on fresh food, filling gaps with buy now, and using credit cards to cover bills that were previously paid with wages. When consumption is sustained by debt, the economy may appear to function from a distance, but the real economy at the household level is beginning to crack. The question is, if growth is real, why are more and more people relying on the most expensive source of capital in the personal financial system? If the labor market is still described as stable, why are signs of defaults and bankruptcies becoming recurring themes in the regular reports? And if this is a widespread phenomenon, what is really at work beneath the beautiful numbers? A recovery, or a temporary bridge propped up by interest rates and confidence? On the surface, the U.S. economy in the post-tightening period still maintains some acceptable indicators. Gross domestic product hasn't collapsed, nominal consumption hasn't plummeted, and regular reports still show that household spending continues to be sustained. However, when the structure of consumer spending flows is dissected, a different picture gradually emerges. Much of the growth in spending doesn't come from a sharp increase in real income, but from the use of short-term credit, especially credit cards and high-interest consumer loans. The total credit card debt of Americans has reached a new peak, reflecting the reality that cards are no longer primarily used for flexible or emergency spending, but have become a tool to cover monthly budget shortfalls. This creates an illusion of stability. Money flows, businesses remain open, but the underlying foundation is debt. Statistically, the overdue debt ratio may only have edged up by a few percentage points, not enough to trigger a full-blown crisis. However, these average figures mask a very strong divergence. High-income groups still have the ability to rotate credit and restructure debt, while middle and low-income groups are beginning to slide into a state of prolonged minimum payment, a gray area between stability and default. Individual bankruptcy reports show a resurgence in new filings, particularly in the form of complete debt forgiveness. This signals that a segment of the population has overcome the point of no return through credit rotation. Nevertheless, on the surface, this phenomenon is not significant enough to shake macroeconomic indicators, leading many observers to believe that the system is still managing the risks. The surface picture is therefore deceptive. The economy appears to be functioning, but the engine is overheating due to the high cost of fuel. When consumption is fueled by debt instead of income, the question is no longer whether there is a problem, but when will the problem emerge? In official reports, the economy is measured by rates, averages, and trends. But the lives of millions of Americans are measured by payment schedules, bills due, and paycheck balances. It is here that the most dangerous discrepancies begin to form. Statistically, the rate of delinquent credit card debt is considered increasing but still manageable. In reality, for individual households, delinquency isn't a binary state, yes or no, but a gradual slide. It often starts with paying the minimum for a few months, then skipping a payment, and gradually accumulating interest, penalties, and a declining credit score. By the time data shows a debt officially delinquent, the borrower's life has often been strained for a long time. This discrepancy is also reflected in the concept of living income. Nominal income may increase, but disposable income, the remainder after paying for housing, insurance, healthcare, energy, and food, is eroded. In this context, credit cards become a tool for maintaining a minimum standard of living, rather than a means of flexible consumption. Many households don't use their cards for shopping, but rather to extend their ability to pay for essential needs. Real-life stories reveal a recurring pattern. A small incident like reduced working hours, unexpected medical expenses, or home repairs can disrupt a fragile financial balance. In such cases, credit card debt is no longer a safety net, but a slippery slope leading to personal bankruptcy. However, these moments rarely appear in macroeconomic data because they are dispersed and occur subtly. The discrepancy between data and real life is therefore not just a statistical issue, but a perceptual one. When average indicators remain acceptable, society easily believes that financial pressure is merely an individual issue. But when these small stories are placed side by side, a larger picture emerges. Millions are propping up the consumer economy with their own financial fragility. This is where the question needs to be re-examined. If the numbers aren't alarming, is it because the system is still healthy, or because damage is accumulating in areas where statistics only detect it when it's too late? To understand why credit card debt has become a breaking point for household finances, we need to look beyond individual behavior and examine the operational structure of the U.S. economic and financial system over the years. This is not a random slip-up, but the result of multiple layers of overlapping mechanisms. First, there's the prolonged high interest rate environment. When monetary policy is tightened to curb inflation, benchmark interest rates rise, but the strongest impact falls on unsecured consumer loans. Credit cards, already having high interest rates, become the fastest channel for capital costs. For borrowers, this means each month of late payment not only increases debt but also exponentially reduces their ability to escape debt. Second, there's the fee structure and credit algorithm. The credit card system is designed to maximize profits from imperfect customers, volatile interest rates, late payment penalties, and declining credit scores trap borrowers in a cycle of high interest rates. Once credit scores decline, cheaper refinancing options virtually disappear, forcing borrowers to continue relying on the very tools that put them in trouble. Thirdly, the labor market is outwardly stable but inwardly fragile. Unemployment may not skyrocket, but many new jobs offer lower pay, more indefinite hours, or fewer benefits. For millions of households, the risk isn't about losing their jobs entirely, but about losing income certainty. In this context, credit becomes a way to offset uncertainty, albeit at an increasingly high cost. Finally, there is the growth model based on debt-driven consumption. For decades, household consumption has been the primary engine of the American economy. When real incomes don't keep pace with the cost of living, the credit system expands to sustain demand. This helps the economy avoid short-term shocks, but it accumulates long-term risks at the household level. Credit card debt, therefore, isn't a systemic failure, but rather a part of that system. When these factors are combined, the picture becomes clearer. People aren't simply overspending. They are reacting rationally within a structure that forces them to choose between drastically cutting living expenses or borrowing to maintain a minimum level of stability. And it is at that intersection that credit card debt becomes a warning sign that a growth model has reached its limit. When credit card debt extends beyond personal finances, the consequences begin to spread throughout the entire economic structure. The first thing that happens isn't a sudden collapse, but a quiet contraction of consumption. Households burdened by high debt are forced to prioritize paying interest and fees, meaning cutting back on non-essential spending. This makes retail, service, and entertainment businesses feel the weakening purchasing power, even before aggregate indicators fully reflect it. At the corporate level, cash flow becomes more unpredictable. Companies dependent on mass consumption face declining revenue while capital and operating costs remain high. Consequently, a wave of downsizing, store closures, and job cuts begins to appear sporadically. Notably, this phenomenon isn't limited to small businesses or low-income sectors. It's spreading to large brands previously considered immune to recession. The next ripple effect appears in the financial system. As delinquency rates rise, card issuers are forced to tighten credit conditions, limits are cut, and interest rates for high-risk groups continue to rise. A negative feedback loop forms. Borrowers find it increasingly difficult to access cheap credit, while the need for credit to cover essential expenses remains. This exacerbates financial inequality, as those with better affordability enjoy favorable conditions, while the rest are trapped in expensive products. On a macro level, the weakening consumption puts pressure on the labor market and investment. Businesses delay expansion, hiring slows down, and long-term investment plans are postponed or cancelled. These decisions, while rational at the business level, contribute to a growing sense of insecurity in society, making consumers even more cautious. The economy thus entered a state of gradual slowdown, not weak enough to be called a formal recession, but not strong enough to inspire confidence. The ripple effect of credit card debt reveals a crucial truth. When financial pressure accumulates at the household level, it doesn't stop there. It moves through consumption, businesses, the credit system, and ultimately back to workers, creating a vicious cycle where each turn diminishes the economy's resilience. When credit card debt is discussed in economic forums, the focus is often on the total amount and the delinquency rate. However, many important aspects are overlooked, making the picture superficial if viewed solely from a statistical perspective. The first is the stratification of risk. Not every dollar of credit card debt carries the same level of danger. For high-income earners, credit cards are merely a short-term cash flow management tool. But for middle and low-income earners, the same tool is crucial for survival. Using credit cards to pay for essential expenses blurs the line between consumption and emergency debt, increasing the vulnerability of millions of households. The second is the psychological and mental health factor. The pressure of prolonged debt not only affects finances but also life decisions, delaying marriage, reducing childbirth, taking on multiple jobs simultaneously, and accepting higher risks in employment. These impacts are rarely quantified, but they have long-lasting effects on social structure and economic productivity. Another often overlooked aspect is the role of credit card debt in masking economic weakness. When people continue to spend using credit, consumer indicators may remain stable in the short term, creating a sense of stability for the market and policymakers. But this stability is bought with accumulated risk. When credit tightens or borrowers are no longer able to refinance, economic adjustments occur more quickly and painfully. Finally, there is a mismatch in policy responses. Monetary policy tools are designed to impact at the macro level, but their consequences fall most heavily on high-interest consumer loans. Meanwhile, consumer protection measures are often slower and more fragmented. This gap leaves many households bearing the shock for extended periods before any adjustments occur. These often overlooked aspects show that credit card debt is not just a financial variable, but a social indicator. It reflects how an economy distributes risk between the system and the individual, and how silent pressures can build up until they become a broader crisis of confidence. When credit card debt is no longer a short-term solution but becomes a long-term problem, the most dangerous impact isn't on the balance sheet, but on trust and social psychology. This is the stage where the crisis shifts from numbers to feelings, from economic to psychological. First, there's the erosion of confidence in financial independence. Many households are beginning to realize that, no matter how hard they work or how carefully they spend, they can't escape the cycle of paying interest. This feeling of being unable to move forward creates a state of prolonged financial fatigue, where decisions are no longer geared towards improving the future, but only towards delaying collapse. As confidence in personal effort diminishes, so does the motivation to work and the willingness to take positive risks. Next, there's a shift in consumer behavior and future expectations. People no longer spend with optimism, but with a defensive mindset. Long-term plans such as buying a home, investing in education, or starting a business are postponed indefinitely. Society is gradually shifting from a build mindset to an endure mindset. This is particularly evident in the younger generation, who enter the labor market in a high-cost, expensive credit environment, yet are expected to shoulder increasingly large economic obligations. The crisis of confidence is also reflected in how people perceive the system. When credit card debt becomes a common trap, the question is no longer what did I do wrong, but is this system designed for me to fail? This skepticism weakens the connection between citizens and economic and financial institutions, from banks to public policy. A society lacking trust is a society that is difficult to recover from, because any stimulus or reform requires time to convince the public that it will bring about real change. Finally, the psychological crisis spreads to the sense of social security. When many people simultaneously experience financial instability, anxiety becomes a collective experience. This creates a prolonged atmosphere of pessimism, even when some economic indicators improve. The economy may recover on paper, but society may not necessarily recover in the public's perception. The crisis of confidence and sentiment is therefore the deepest layer of the credit card debt problem. It determines the speed and quality of any recovery process and raises the crucial question: can an economy truly be healthy if a large proportion of its population no longer believes in their own financial stability? American credit card debt is not simply a large number on a financial chart. It's the culmination of years of growth fueled by borrowed consumption, of a cost of living that outpaces income, and of a credit system that shifts much of the risk to the individual. As these protective layers erode, credit cards become the last lifeline, but also the lifeline that can drag users down further if they cling to it for too long. This story illustrates a core paradox of the modern U.S. economy. To maintain a short-term image of stability, society has accepted a long-term degree of fragility. Macroeconomic indicators may recover first, but the financial lives of millions of households will take much longer to heal. Without addressing this gap, any recovery will be merely superficial and easily reversed when the next shock strikes. The humanistic message of the issue lies not in blaming borrowers or glorifying personal discipline. The focus should be on how the system allocates risk and protects the most vulnerable. A sustainable economy cannot rely on people constantly borrowing at high costs to maintain a minimum standard of living. True stability requires policies that help incomes keep pace with expenses, increase transparency and fairness in consumer credit, and create shock-absorbing mechanisms for households facing crises. Ultimately, credit card debt is a mirror reflecting the state of society. It shows not only how money is spent, but also how trust is distributed. When so many people live in a precarious financial state, the big question is no longer whether the economy is growing, but who that growth is serving, and at what cost. An economy is only truly strong when its stability is felt at the level of everyday life, not just demonstrated on the charts.